This is Quent Bilo with an introduction to budgetary planning. In this talk, we'll focus on budget basics and benefits and look at the two major classifications of budgeting that comprise the master budget, known as operating budgets and financial budgets. The term budget is really a shorthand term to describe a variety of budget documents. All of these documents combine into what's called the master budget, a series of interrelated plans. When it comes to operating budgets, we'll be mainly concerned with the sales budgets and their relationship to production budgets, and direct material purchase budgets and direct labor planning budgets and their relationship to the production budget. The first observation is the hierarchical nature of budgets, everything starting with sales. We can't forecast production until we have an estimate of sales. Both of these budgets will be expressed in terms of units. Finished good units. Only once the production budget is in place can then get into the details that make up our product costs, the direct material dollars involved, direct labor involved, etc. These lower level budgets will be expressed in dollars. Of course, we'll first calculate the quantity of materials to be purchased, which can then be quickly converted to a dollar basis. Direct labor hours will be calculated, which is the quantity of labor then quickly converted to a dollar basis as well. As indicated, a budget is a formal written statement of management's plans. It's a way to communicate agreed upon objectives. Accountants translate all the goals and assumptions of the budgeting process into financial terms. As a background comment, the actual crunching of numbers is much less time-consuming than gathering the historical data upon which those assumptions are made. Most of the problems you'll be working with are the crunching side. Just be aware a budget analyst would spend the bulk of their time preparing to crunch the numbers, assembling assumptions, and reviewing their reasonableness. Companies use budgeting to facilitate planning and control within the business in order that they can manage the financial aspects of their business and plan for such things as new product expansion in the future. Budgeting also allows for the evaluation of performance of companies during the planning period. This view lists 6 benefits of the process: a planning device, working with objectives, setting expectations that can give an early warning system to management, coordinating activities like purchasing, production, etc. Properly implemented, a budget can motivate employees to attain their objectives. Improperly implemented, a budget could be demoralizing. Our calculations will concern ourselves with the planning function. To answer such questions as to how much to produce, how much raw material to purchase, and how much labor to plan for. Review question: which of the following is not a benefit of budgeting? It enables disciplinary action to be taken at every level of responsibility. Budget should not be used as a hammer. The effectiveness of budgeting does require a somewhat mature organization that has assigned responsibilities. Budget buy-in is essential. Budgets typically cover a year or a 12-month forecast rolling period where 1 month of actual results drops off and another is added, a forecast month. That's known as continuous budgeting. Planning horizons beyond a couple of years are really into strategic planning periods, not the subject of this chapter. This is a reminder: all budgets start with a sales forecast, and the process takes off from there. Here's a laundry listing of factors to consider in developing a solid sales budget. I'll let you acquaint yourselves with them as you read the chapter. Here's a reminder that participative budgeting is the best. not just inputs from senior management. The goal is to have a budget that is attainable, perhaps with some stretch. But there's a price to pay for participative budgeting. It takes time, and some individuals may attempt to pad the budget through very easy to make assumptions or goals. Again, budgets are short term, typically a year. Further out projections are part of a long-range planning. Review question. The essentials of effective budgeting do not include top-down budgeting, meaning not just the decisions of senior management demanding sales objectives, reduced cost objectives, etc. The input of other personnel in the organization is key to a budget that is accepted by the organization. The master budget is a one-year budget planning document for the firm encompassing all the other budgets. It coincides with the fiscal year of the firm and may be broken down into quarters and further into months. What are the major parts of the master budget? It usually has two parts: the operating budget and the financial budget. Operating budgets show income-generating activities from the firm, including revenues and expenses. The result is a budgeted income statement. The financial budget shows the inflows and outflows of cash and other elements of the firm's financial position. The inflows and outflows of cash come from the cash budget, which will include other operating budget requirements, plus the capital expenditure budget, purchases of property, plant, and equipment. As such, the result of the financial budget is the budgeted balance sheet. Operating budgets are prepared first, as information from the operating budgets is needed for the financial budgets. The operating budget is actually composed of approximately 6 supporting budget planning schedules. They are interrelated and come together to develop a budgeted income statement based on the operating budget. As concerns number crunching, problems will typically present themselves with expected sales requiring you to then forecast the production budget to support the sales budget. And production requirements of the current period do not just equal the sales of the current period. If a business sells out of beginning inventory, it doesn't have to produce it currently. Likewise, if a business wants to have some ending inventory left at the end of a period of time to anticipate sales in the next period, it will produce more in the current period. Jumping ahead to key budgeting relationships, as budgeting starts with sales out of our finished goods inventory account, we will not abandon the flow we learn through key inventory accounts. Now, we may shorten it a bit at this point. Budget planners typically don't forecast work in process inventory as an example, but we use our beginning finished goods plus current production, B plus A, calculation to determine the total amount available goods for sale. And recognizing that at period end, either we'll have finished goods on hand or it's been sold. So if we're given our sales units, we can make a backtrack calculation of our needed production. And in turn, from our production requirements, we can calculate how much raw materials are needed to support that. And in turn, from raw materials requirements, we can compute how much raw materials are needed to be purchased during the next budgeting period. So the beginning budgeting cycle goes from sales to production to raw material requirements to raw material purchases. That's an operating budget calculation cycle you'll want to nail. This view leaves off direct labor because it's not inventoried in the sense that we have leftover labor at month end, but we do have to plan on a given level of labor hours needed, just like we forecast the amount of raw materials needed to support the production budget. So, direct labor budgeting will be a part of our calculation in this chapter. I'm not going to dwell on overhead or selling administrative budgets. You can review comments in your textbook. But the finale of operating budgets is the forecast income statement. The second major classification of the master budget is the financial budgets. The three components of those shown below: the capital expenditure budget, the cash budget, and the forecast balance sheet. They are derived after we've concluded the operating budget, because those operating budgets will be used as we do cash budgeting and develop a budgeted balance sheet. Expected capital expenditures on long-lived assets also become an element of the cash budget. The cash budget determines if expected borrowing may be needed to satisfy all our cash requirements, which will include a minimum cash balance to maintain. Possible expected borrowings of cash, or the reverse, a repayment of debt, is a major answer arrived at by doing the cash budget. By the way, any forecast depreciation expense is ignored by the cash budget since it's not a current use of cash, even though it's in the forecast income statement. Let's review some terms. Let's plug these 6 terms into the questions down below. Number 1, what shows potential sales for the industry and a company's expected share of such sales? The sales forecast. Number 2, what are used as the basis for the preparation of the budgeted income statement? Operating budgets. Number 3, what is a set of interrelated budgets that constitutes a plan of action for a specified time period? That's the master budget. Number 4, what identifies long-term goals, selects strategies to achieve these goals, and develops policies and plans to implement the strategies? Long-range planning. Number 5, lower-level managers are more likely to perceive results as fair and achievable under what type of approach? A participative budgeting approach. Number 6, what focuses primarily on the cash resources needed to fund expected operations and planned capital expenditures? Financial budgets. The first schedule to develop is the sales budget, which is based on the sales forecast. The sales budget is not usually the exact same as a sales forecast, but it's adjusted based on managerial judgment and other data. This is a nuance you need not deal with in homework problems, but in practice, there usually is a difference. Every other budget depends on the sales budget. The sales budget is easily dollarized by taking sales unit volume times expected selling price. Here's an illustration. The Hayes Company expects sales volumes of 3,000 units in the first quarter and a 500 unit increase in each succeeding quarter. Sales price, $60 a unit. So for the first quarter, 3,000 units times $60 extends to $180,000 total sales budget, and so on. The point I want to make here is that we'll primarily be given unit volumes, and that's what we'll be working with. Sales unit volumes. The follow-on question will be, what's the level of production volume needed to support the sales unit volume forecast? So from unit sales budget volume, we'll be asked to determine how much we should produce to support that expected sales. Production volume is also in units. From that, we'll derive how many direct materials are required to support that production budget. There'll be a calculation in units of raw materials, which are at a lower detailed level. And once we know the direct materials required, the question will be, what do we have to purchase in terms of quantity to support that direct material requirement? Lastly, we have to plan for direct labor. very similar to the quantity of direct materials. That is, how many labor hours are required to produce the budget, the production budget, which in turn supports the sales budget. Two items which are inventory related: finished goods inventory and raw materials inventory. The calculations above are the subject of the next follow-on talk. A reminder, the inventory flow formula we used in prior chapters can be readily adapted to problems in this budgeting chapter. That is, the base formula. B plus A equals S plus C. The beginning balance of inventory plus additions during the period, total available, B plus A, are either still on hand, E, at the end of the period, or they move on to the next level, S, are subtracted out of that inventory level.